In this video, we are going to dissect what is really happening in South Florida commercial real estate in 2024 and 2025 across multifamily, industrial, and retail using hard data on migration, jobs, and capital flows in Miami Dade, Broward, and Palm Beach counties. If you are a broker, owner, or limited partner, think of this as a mini investment committee briefing. We'll look at where fundamentals are strengthening, where they are softening, and where the real risk-adjusted opportunities lie over the next 12 to 24 months. Start with the demand side. People. Florida's population pushed past 23 million residents in 2024, and the state is expected to keep adding well over 300,000 people a year through the middle of this decade. In 2023 alone, Florida saw roughly 940,000 people move in, and just over 510,000 move out, leaving a very large net gain. The origin story matters. The largest streams of inbound movers into Florida over this period came from high-tax, high-cost states like New York and California, along with strong flows from New Jersey, Illinois, and other East Coast markets. These households bring higher incomes and different expectations around product quality, which supports demand for Class A and well-amenitized Class B multifamily, as well as higher rent retail in key submarkets of South Florida. Within Florida, the Miami-Fort Lauderdale-West Palm Beach region continues to capture an outsized share of growth. Recent regional planning and population studies show the Tri-County area adding on the order of 100,000+ residents over 2023-2024, pushing the combined population to roughly the mid-6 million range. That translates into growth of around 1.5% to 2% in a single year, well above the national average. This inflow is not just retirees. The region is attracting working-age households, entrepreneurs, and remote professionals who can live anywhere but choose South Florida for tax, lifestyle, and connectivity reasons. That mix supports demand for rental housing, logistics space to support consumption, and neighborhood retail that serves both locals and visitors. Population without jobs is speculation, so let's look at employment. A 2024-2025 economic outlook for South Florida highlights that Miami Dade, Broward, and Palm Beach collectively are projected to grow total employment by roughly 4.5% over a multi-year planning window, outpacing U.S. growth. The largest employer categories are trade, transportation and utilities, professional and business services, education and health, and leisure and hospitality. By June 2025, the Miami-Fort Lauderdale-West Palm Beach Metro had added about 42,600 jobs over the prior 12 months, a growth rate of 1.6%, compared with around 1.7% nationally. Miami-Dade alone counted more than 120,000 businesses, with Broward and Palm Beach adding tens of thousands more, underscoring how diversified the regional economy has become. These sectors directly support demand for apartments to house workers, industrial space to move goods, and retail to capture both local and tourist spending. Now capital. After a sharp slowdown, capital is returning to South Florida. In 2024, commercial sales jumped 36% to $12.5 billion, and through Q3 2025, sales are up another 18%. Investor surveys rank Miami a top investment target, with 70% planning to be net buyers. Pricing has adjusted. A mid-2025 snapshot shows multifamily cap rates across Florida around the mid-5% range, roughly 5.5%, slightly higher than the U.S. average, after bottoming at much lower levels during the stimulus era. In Miami specifically, Class A multifamily in good locations is transacting in the high 4s to low 5s, with Class B and C assets trading at noticeably higher yields. Industrial and prime South Florida locations still commands relatively tight cap rates in the mid-5s, reflecting strong long-term demand and land scarcity. Retail cap rates vary widely by submarket and asset quality, but prime urban retail often trades at a premium to most Florida markets because vacancy is low and rents are high. For buyers, the message is that yields have improved compared with 2021. But you are paying for genuine quality, not speculation. Multifamily has gone from boom to digestion. Developers delivered a large wave of Class A product in 2023 and 2024, and more is coming online in 2025. As a result, regional vacancy has moved from the mid-5% range into the low 6% range, even as asking rents remain slightly positive year over year. Average asking rents in key South Florida markets have plateaued or grown modestly rather than continuing the extreme increases seen earlier in the decade. That combination, more units, slightly higher vacancy, and slower rent growth, means the market is no longer forgiving optimistic underwriting. Concessions have become more common in Class A lease-ups, especially in the most supply-heavy submarkets. In 2024-2025, credible multifamily strategies are targeted. Focus on value-add plays, acquiring older communities to reposition for middle-income renters, and opportunistic recapitalizations of deals struggling to refinance. County dynamics also matter. Miami Dade has the most supply risk but the deepest renter pool. Broward offers a balanced mix of growth and stability. Palm Beach has a constrained pipeline and high-income households, supporting lower volatility business plans. Industrial remains a core strength in South Florida, though conditions are balancing post-pandemic. Millions of square feet of new supply pushed vacancy from sub-3% to the high 4% range, flattening rent growth, though rents remain at historic highs. Sales volumes are down as buyers and sellers negotiate yields in a higher rate environment with more supply in the pipeline. The logical core plus industrial strategy in 2024-2025 is simple. Prioritize modern, functional logistics assets near critical infrastructure, airports, seaports, and major highways, and in infill, land-constrained submarkets where long-term demand is very sticky. These assets should remain competitive across cycles and give landlords pricing power once the current construction wave is absorbed. More opportunistic capital is targeting either new speculative projects that delivered with limited pre-leasing, accepting lease-up risk at the right basis, or older infill warehouses where current in-place rents are materially below market and can be pushed as leases roll. Underwriting today must assume slower rent growth and longer lease-up timelines than in 2020-2022, but the structural drivers, population, consumption, and constrained land, remain intact. Retail in South Florida has quietly become one of the most resilient property types. Region-wide vacancy has held around the low 3% range for several years, with only a slight uptick despite macro volatility. Meanwhile, asking rents in prime Miami retail corridors are in the mid-$40 per square foot range on a triple net basis, while Fort Lauderdale and Palm Beach markets are in the mid-30s, all trending upward. Recent reports show retail vacancy in the Tri-County region around 3.2% in late 2024, with average asking rents climbing from about $36 to nearly $37 per square foot in a year. In Miami specifically, vacancy is closer to 2.7%, while Palm Beach sits around the mid-3% range, but with some of the strongest rent growth in the state. This is a classic, low-supply, stable demand story, which tends to favor existing landlords. In 2024 and 2025, the most attractive retail plays are operational, not speculative ground-up projects. The focus is on re-tenanting and repositioning older centers with tenants that benefit from population and income growth. Grocery-anchored uses, medical and wellness, fitness, and daily needs and experiential concepts. Investors are also creating value by adding outparcels, drive-through pads, and incremental GLA where zoning allows, particularly in strong traffic corridors. While retail sales volume has lagged other sectors due to the rate shock, many owners are choosing not to sell. The underlying fundamentals in South Florida retail remain some of the best in the country. For buyers with a long-term hold horizon, carefully selected centers in high-barrier, high-income locations present compelling risk-adjusted returns. South Florida's commercial real estate market is rebounding strongly, with sales volume rising significantly. Yet each county behaves differently. Miami-Dade offers high liquidity and pricing, but also greater supply risk. Broward provides a balance of yield and growth, while Palm Beach combines high-income demographics with tighter inventory and a more relationship-driven deal environment. The line between value-add and opportunistic is especially important. Value-add means fixing existing assets, capturing mark-to-market rents, or improving management. Opportunistic strategies take on structural risk, like new development or distressed deals where 2021 financing no longer works. In this cycle, success requires selectivity, where pricing compensates for risk and long-term demand drivers are undeniably strong. The through line across all asset types is discipline. Underwriting in this environment demands conservative rent growth assumptions, realistic vacancy and downtime, and exit caps that reflect a higher-for-longer rate regime rather than an automatic return to 2021 pricing. At the same time, South Florida's structural tailwinds, population inflows, diversified employment, and physical and regulatory constraints on new supply remain intact. The investors who will outperform over this period are those who pair those macro tailwinds with rigorous, bottoms-up submarket and deal-level analysis, instead of leaning on vague, "Florida is hot" narratives. For brokers and sponsors, that means creating offering materials that actually walk through supply, absorption, and rent comps, rather than relying solely on storytelling. If this breakdown helped sharpen your thinking about multifamily, industrial, or retail in Miami-Dade, Broward, or Palm Beach, do two quick things. First, like this video so more serious investors and brokers see data-driven content in their feeds. Second, subscribe to the channel and turn on notifications so you don't miss upcoming deep dives. We'll cover specific submarkets, walk through live deal case studies, and break down real underwriting models line by line. And if you're a broker, principal, or limited partner actively working on a South Florida deal, drop a comment with the county, asset type, and business plan you're focused on. Future episodes will prioritize the markets and questions that show up there most often.